Welcome, and in this video I am going to be showing you how to calculate full implementation shortfall in costs and as well as basis points, and we're going to break all parts of the trade down. So the first thing you need to know is to calculate our execution costs. Now what we're going to do here is look first at our execution price and how many shares we've executed for the trades. So we see here we have 4 trades executed at various prices at various amounts. So what we'll first do here, and above here we've seen we've executed a total of 80,000 shares. Here are the details of the trade. We wanted to trade 100,000 shares. Decision price, that's the price that we wanted to trade at. We wanted to trade at $30. This will be really important coming along. Arrival price. This is the price that the trade was entered into the market at. So we submitted the trade to the market when the price was 30.10. As we can see here, we have 30.10, but the first price trade didn't get executed at 30.20. So there was some movement there of some costs. Commissions per share, 2 cents. So it costs us 2 cents to the broker per trade. So each share we executed costs us 2 cents. 80,000, that's how many we've actually executed. As you can see down below matches, and 30.65 are our closing price. That's at the end of the day. The stock here closed at $30.65. So now we've got the basics of the trades down. We'll go back and first calculate our execution costs. So our execution costs, we'll look at here how many trades we executed at each price. So we'll take our execution price times our shares executed. So 906,000, we'll move it down for each one, and we'll sum those up. So it cost us $2.4 million for these trades. Now we also want to know is what was the average price that we got all these trades for shares here. So we got, take our $2.4 million divided by how many shares we've executed, and we got that at $30.31 was our average price. Our average price there. So to get here our execution cost, we will take what we got, that average cost, $30.31, and what we could have gotten it for, $30. But we'll do it on a per share basis so you can see what the execution cost per trade was. So for trade number 1, we'll take our price that we got it at. Take a price that we got it at. We'll subtract what we wanted to get it at. We wanted to get it at $30, but we didn't. Got it at $30.20. And we'll multiply it by how many shares? 30,000. So the first trade cost us $6 grand. Here, let me just throw this. Here we go. So for a total cost of $25,000. This is our execution cost. And next thing we want to know is, well, it took us some time to get it out into the market. So that was our delay. What was the delay cost? So we'll do the delay cost. And our delay cost is what we wanted to get at 30, but it took us some time, the 30.10. So our delay cost is the difference between what we took the time to get out to the market minus what we wanted to do. Remember, we always do what we wanted to do at $30 times how many shares we executed. So we executed 80,000 shares. So our delay cost is $8,000. Just move it out of here. $8,000 is our delay cost. Next thing we have is the cost of trading, because execution is broken up into delay and trading cost. So trading cost, and this is where we have our average price come down. Now, delay was between 30.10 and 30. Our trading is between the 31.31 and our delay, our arrival price. So we'll take our $30.31. We'll subtract our arrival price the time we submitted to the market, and we're going to multiply it by how many shares we executed. 80,000. That gives us $17,000. Now what you could have done is just take 25 minus 8,000 to get 17, but if you're not given that, if you're on an exam or something, this is how you can calculate it yourself. Now this is going to be our fixed fees, and these fees, as we said, are 2 cents a share for 80,000 shares. So our fixed fees cost us $1,600. Now there's one last fee that we don't have in here, and that's our opportunity cost. Our opportunity cost represents inefficiencies. We could have been better. We could have. Why couldn't we execute those additional 20,000 shares? Because we wanted to execute 100, we could only execute 80. So we missed out on 20,000. So we'll take our 20,000 share, 100,000 minus our 80. And then we want to see what we could have executed at 30, and that could have gone up to 30.65. So instead of just taking 30, we want to look at that difference of what we could have gained of 30 to that 65-cent gain. So we'll multiply it by the difference between 30.65 and our decision price of $30 for a total opportunity cost of $13,000. And you can see our total implementation shortfall, IS, is going to be equal to our delay plus our trading plus our fixed fees plus our opportunity cost, $39,600. Now, a lot of times you'll want to know what it is in terms of basis points. So for the basis points, we're going to take the cost in dollars, and we're going to divide that by the total cost of what we would have wanted the whole, if we executed all our shares that we wanted to execute at the price that we wanted to execute it at. So we'll take, for execution costs, for instance, we'll take our execution costs, and we'll divide that by how many shares we wanted to execute times the price we wanted to execute it at, multiplied by 10,000 to get our basis points. So we'll just move that here. 83.33 basis points. And the same thing will be for our delay costs, trading, fixed fees. So delay costs, again here, $88,000 times the 100,000 shares times the $30 that we wanted to. We wanted, if everything had gone right, we would have gotten 100,000 shares at $30 a share. So 26.67 basis. This is all in basis points down here. This line, these lines here will all be in basis points value. So 26.67. Our trading costs will be 17,000. Our fixed fees will be 5.33. Our opportunity costs will be 43.33. And our total implementation shortfall in basis points is 132 basis points, broken down by each sub-cost in basis points, as well as each sub-cost in dollar amounts. So that is how you do a full implementation shortfall when you're given your decision price, your arrival price, a breakdown of awaited your trades at each different prices. So you can come up with your costs in dollars and your costs in basis points for each, for an expanded method or just the shortfall method. And thank you, and thanks for watching, and have a good day.